Welcome to More Than Money with your host, Ross Murray. This episode of More Than Money is brought to you by More Time Financial, a financial planning company who are on a mission to help young Australians make smarter decisions with money by providing real-life financial advice, coaching, and financial education.
Hey, what's up? It's Ross Murray. Welcome back to another episode of More Than Money. On this podcast, I have real conversations about lifestyle, money, and business. Sometimes I share interviews with business owners and entrepreneurs about starting their own business and their journey. Other times we do financial education and informational episodes to help you make smarter decisions with money, just like this one. So if you're new here, consider subscribing. Now, before we get started on today's episode, this is just a friendly reminder in order to keep our lawyers happy that in preparing this podcast, myself and any contributors have not taken into account any particular person's objectives, financial situation, or needs. So before acting on any of this information, you should consider its relevance to your personal circumstances, and if required, seek the assistance of a licensed professional. And on today's episode, we're talking about emergency funds and insurances. In the past couple of episodes, we've been talking about how to build your financial foundations, how to start saving and get out of debt. And now it's time to talk about how to protect your wealth. The protection plan is definitely the least exciting part of your entire financial plan, but it's probably the most important because it makes sure that you are protected, your family are protected, and your money is protected. We're going to talk about the steps 1 and 2 of building your 3-step financial protection plan. And those are your emergency fund and insurance cover. So stay tuned, and that's what we're going to be covering today. So step number 1 in your financial protection plan is an emergency fund. An emergency fund is an amount of money that you set aside for, as the name suggests, emergencies. Now, the amount that you need is going to be dependent on your personal circumstances. So if you're single, no children, no debt, the amount of money you need to set aside for an emergency fund is going to be a lot less than someone with a family of 3, a large mortgage, all those things that obviously adds to the financial complexity. Regardless of how much you need, it's important that you have an amount of money set aside in case the worst does happen. Now, an emergency can range from anything of a car breaking down, you need a new fridge, maybe a medical emergency, so one of your children gets hurt and needs to go to the hospital for whatever reason, or something a bit more serious that you get injured yourself and you can't work for a period of 6 months. So that's where it starts to get a little more interesting, is that when we look at those things that, okay, this could happen, we hope that it doesn't, but we want to plan that if it does, it's not a nightmare. We've got the money there that we can take the money out of our emergency fund and we make it a small inconvenience rather than an emergency. So step number 1 of looking at that is figuring out how much do you actually need. Now, the way that we think about it purely from a financial perspective is having a minimum of 3 months of living expenses. If you'd listened to the previous episodes, you would know what we break down your living expenses, your lifestyle expenses, and your entertainment expenses. So the reason we like to use living expenses is if shit did hit the fan, something really bad did happen, you could cut out your lifestyle expenses, you could cut down on your entertainment expenses to a point, but your living expenses are that bulk amount of expenses that you need to live, which is why we call it your living expenses. So that's make sure that you're paying the mortgage or paying the rent, putting food on the table, make sure you can keep the lights on in terms of electricity. So at a minimum, we like to use a 3 months figure of living expenses. Now, that might not be enough for you. There's always the financial side of it, and then there's the emotional side. The financial side says, okay, at a minimum, let's aim for 3 months. If we can do more, if we can push to 6, that's great. Some people like to have 12 months worth of living expenses or 12 months of income set aside as their emergency, and that's entirely fine, because it's important to understand that there's going to be that amount of money that you need to feel financially secure. It might not make any financial sense whatsoever. We've had some clients come in and say, I need to have a minimum of $100,000 in cash. It makes no sense to have $100,000 sitting in cash doing nothing. Yes, we could put it in term deposits and things like that, but regardless, they said, I need to have $100,000 set aside. That is my number. I can't sleep at night if I don't have at least $100,000 in cash sitting somewhere. For them, that's their number. So as I said, we can take the financial approach and say, this is 3 months worth of living expenses. We can see what that figure is. That might be $20,000. Or we can say, okay, what's your emotional number that you need to have set aside in cash to make sure that you feel financially secure? That is the emergency fund. So if you've been following along in the steps, you would know that the plan is that we have a mini emergency fund of approximately $2,000 to $5,000 set aside. We want to clear all those debts. Once we've got on top of all those bad debts or those shit debts, then we can work on building up our emergency buffer, our emergency fund. Then we need to make the decision of, okay, if we are building this emergency fund, where are we going to store it? Now, we've got a couple of options, but the main thing to realize or think about is, can we access this money at a moment's notice? And the way that we think about it at a moment's notice is within 24 hours. So if something did happen, can we get our hands on this money within 24 hours? That means that we're not going to be investing this money in the share market because that's probably going to take too long to withdraw it and transfer it when we need it. The ideal situation would be having it either in a cash savings account, potentially a term deposit, depending on what the rules are there. If you have a home loan that has an offset facility, an offset account is a perfect example of having it sitting there. Maybe you have it in a redraw facility, but whatever place we want to put it, we just want to make sure that we can access maybe not all of it, but at least some of it within 24 hours notice, that if we do need it, we know that it's there. So the other things we might think about when it comes to emergency fund is not only the cash that we have in savings, but looking at those other things that potentially, do you have any annual leave or holiday leave, sick leave built up at work that you could potentially access if we need to? Do we have any money in shares that we would be willing to liquidate if we needed to? Now, we're not saying we have to liquidate it, but if we say, okay, we've got some money set aside in cash that we can access at 24 hours notice, do we have some sort of share portfolio or something that we would be willing to liquidate if we needed to? And then finally, do we have any money sitting in our home loan redraw facility? So if you're not sure of what that means, log into your bank, see if you have access to a redraw facility. You might have a bit of money sitting there. Now, knowing that just gives us a sense of comfort. So, okay, we're going to have X amount in cash that actually sits in cash in a savings account. Yes, we know it's not the best return on our money. Yes, we know it's probably not the best use of our money, but we're not trying to solve our financial wealth building problems right now. We're just trying to solve our emergency savings, keeping our emotions in check if something did happen. But that's our cash component. And now we could have our money sitting in redraw. So that might be step number 2. We could have money sitting in a share portfolio that we could liquidate, and knowing that we might have some access to annual leave, sick leave at work that we can access if we really needed to. We can say, okay, here's our 4-step emergency plan: a redraw, annual leave, and a share portfolio that we might be able to liquidate. If you're not sure of how to calculate your living expenses, go back to episode 45. Have a listen through there when we talked about savings accounts, buffers, and how we work those figures out. Figure out what is that figure for you, and let's start building our savings buffer to get to that emergency savings fund. Step number 2 in our emergency financial plan is insurances. Now, I'm still yet to meet anyone that I work with that is either happy to talk about or happy to pay for insurance. We know that it's not the most exciting topic, but it is very, very important if you have people that are either dependent on you, or you're in a position that if something happened and you couldn't work for a period of 3, 6, 9 months, you would be in financial ruin. So that's when insurance starts to become quite important. Now, what we're talking about in today's episode is personal insurance. So anytime you hear insurance going forward, think about personal insurance. Now, personal insurance in our world is anything to do with you as a human. So we're protecting you. So this could be life insurance, this could be disability insurance, this could be what's called income protection, and the final one we're going to talk about today is trauma, or sometimes known as crisis cover. Usually when we think about insurances, we think about health insurance, we think about travel insurance, car insurance, phone insurance, all these other insurance policies that we pay for. But we find that it's usually the last thing that people are willing to pay for is ensuring the most important asset that they own, which is themselves. And we think that income protection is hands down one of the most important insurance policies that you can have, because your income earning potential is your greatest wealth building tool. People won't even think twice about insuring their phone that might cost $1,000. If they're going on holiday, they automatically take out travel insurance. But when we talk to them about income protection, protecting their income, protecting their greatest wealth building tool, it's one of the last things that they're willing to part their money with to put in place an insurance policy. To break down the 4 types of insurance in a little bit more detail, we're going to go through them step by step. Life insurance is probably one of the most common or the most well-known insurance types, because you might see it on TV shows and things like that when they talk about he had a big life insurance policy. So life insurance is pretty straightforward. It's not very nice to talk about, and it's not a very fun topic, but life insurance gets paid out in the event of someone passing away. I don't know why they call it life insurance. It should be called death insurance, but life insurance gets paid out in the event of someone dying. The importance of having that is if you have children, if you have a family, and if you have debt, what position would those people be in, or what your family be in the event of you passing away? Now, you may be the sole income earner, you may earn the same amount of money as your partner, but it's just important to think about, in the event of me not being here, we're going from 2 incomes potentially down to 1, or 1 income to none. What does that look like for my family? Would they still be able to live the life they live? Would they be able to continue to pay the mortgage? what would happen in that circumstance. So that's when it starts to become important. You're like, okay, well, I don't want to pay for it, but I understand the need for life insurance. The second type of insurance that we're talking about today is, we like to call it disability insurance. That's an easier to understand term. Again, terrible topic to talk about, but the full name of the insurance, what the insurance company is called, total and permanent disability insurance, or you might see it as TPD insurance, disability insurance for short. This one starts to get a little bit more complicated than life insurance. Life insurance, it's black and white. You're either alive or you're dead. You either get paid out of policy or you don't. When it comes to disability insurance, it's a little bit more grey when it comes to what is classified as being disabled, or more importantly, what is classified as being totally disabled. Now, this has a range of different meanings, and unfortunately, this is where a lot of insurance companies tend to blur the line in terms of what they classify as disabled and what you as a human being might classify as someone being disabled. Now, the way that it works is that if you can never work in your occupation ever again, that is technically disabled. Now, again, where it gets a little bit more confusing, and we'll maybe need to spend a bit more time clarifying this, is could you do your current job or could you do any job? And what we mean by that is, if you are a labourer and you use your hands to do your job, to build things, if you lost both your arms in an accident and your arms were cut off, you could effectively never be a labourer on the tools ever again. So you could never do the current job you're in. However, could you go and work in a call center? Could you work in the admin department for the building company that you're working for, on the phones that don't require, as weird as it sounds, don't require the use of your hands? Now, that's where it starts to get a little bit grey, of saying, well, I can never be a chippy or I can never be a plumber ever again because I don't have any hands, but I could, not that you'd want to, but you could potentially go and work in a call center that doesn't require as much or any hand movement per se. Now, I know this is a bad example, but you start to see the point where we can do one job, but we couldn't do the job that we were qualified to do. So that's where there's two types of insurance policies. And without getting into so much detail today, but the two types of insurance that you need to consider, the two wordings that you need to consider is, when it comes to putting in place disability insurance or TPD insurance, am I taking out what's called any occupation, or am I taking out what's called own occupation? Now, the key difference between the two is any occupation says that I am totally disabled, or I will only get paid out this insurance policy in the event that I'm totally disabled in any occupation that I'm reasonably trained, qualified, or educated in. So that starts to open that bit broader. So you may have spent 5 years working in a call center, potentially while you're at university or something, and then you've gone to something completely different. So you are effectively, in the insurance eyes, trained and qualified to work in a call center. You may no longer be a labourer, but you could go and work in the call center. So therefore, you disabled in one job, but not disabled in the other. Therefore, the way that they would classify your insurance is to say, am I disabled in any occupation that I'm reasonably trained, qualified, or experienced in? That is the any occupation. So if they had to tick the answer to say no, I can never work in any occupation that I was previously doing, I'm qualified in, anything, I can never do any occupation ever again, then you would get paid out your insurance policy. The other one is own occupation. So the own occupation is a little bit clearer to say, okay, I am a surgeon, I am a doctor, I am a carpenter. These are the roles and functions that I perform as a carpenter. In the event of me never being able to do this job ever again, or this occupation ever again, you'd get paid out the insurance policy in most circumstances. So that's saying that you could go and work at the call center, you could go and work at McDonald's doing something that you worked at high school, but because you have this type of insurance policy that says, this is my own occupation, this is the occupation that I'm currently doing, and if I can never do that again, that's when that insurance policy will get paid out. So without going into too much detail today, this is where it starts to get a little bit grey and to say, okay, life insurance, very simple. Disability insurance, obviously a little more complicated. The next one we're going to talk about is income protection. And as I said, this is probably, besides life insurance, probably the second most common type of insurance, or the one that people tend to understand the most or have some experience in. What happens with income protection, as the name suggests, it protects your income. And why this is important, as I mentioned earlier, your income is your greatest wealth building tool. That if your income stopped, what would happen? Would you be able to continue to pay the bills? Would you be able to continue to save, pay off the mortgage? Probably not. So that's why it's important that we protect your income if you or other people are dependent on your income. Now, if you said to me, look, I work, I don't need the money, I've got enough savings, I've got investments, I've got passive income, then your need for income protection starts to become a bit lower versus the person that's living week to week and that is solely reliant on their income to support themselves or their family. Income protection works, as I mentioned, to protect your income. In the event of you not being able to work in your job, then your insurance policy would potentially start paying you in exchange for your income. So what usually happens is that you might get paid anywhere between 70 to 75% of your pre-injury or pre-accident income. So let's say you have a car accident and you cannot work for a period of 6 months. What would happen if you had appropriate income protection in place is that your income protection provider would come to you and say, hey, we see you have the accident, here's the medical forms, etc. Show us what's happened. What has your doctor said? And you say, well, my doctor's told me I can't work for a period of 6 months. They would make sure that you have all the right checks and balances in place. And if you are approved, then they would start paying you up to 75% of your income. So if you can't work for a period of 6 months, that insurance policy, depending on what you have in place, would pay you for a 6-month period, assuming you have the right cover. And then at that point, you either return to work, or if your policy ends, if you've got a benefit period of 6 months, then at that point, your income protection policy would cease. And hopefully at that point, you can go back to work. If you had a longer, what's called a benefit period, where you get paid for a longer period of time, if you can't work for a period of 2 years, then you could stay on claim, assuming that you can't work. Your doctors are signing off every couple of months to say you can't go back to work in any capacity, or you can maybe go back to work 1 or 2 days. Again, that's where it gets a little bit grey in terms of how much can you get paid, how much can you work, what roles can you and can't you do. You can see by all these 3 types of cover, it's definitely not I hurt my foot so I can't work for 2 days. That's where sick leave and things come into play. These are more severe injuries. So thinking about income protection, I can't work for a period of 3 months, 6 months, maybe 2 years. Thinking about disability covers, I'm completely disabled and I can never ever work again. Thinking about life insurance is obviously there's no after that, it's just you die, you die. Now the final one, which as we can see we start to work in a little bit more technical as we go down the list, is what's called trauma insurance, or sometimes what's known as crisis cover. But this is a type of insurance, as the name suggests, trauma, crisis, obviously pretty severe. Once again, not that I'm sick and I need to take a couple of days off work. This type of insurance is to cover you for some sort of traumatic or some sort of crisis event. Now, the most common types of payouts that we see with this type of cover are heart attack, cancer, and stroke. We all know the rates of cancer, especially in Australia. We all know the rates of heart attack. Stroke's probably a little bit less on that scale, but obviously still quite severe. So if you suffered or diagnosed with some sort of cancer, whether that's a small cancer up to something more severe, if you had some sort of heart attack or some sort of heart condition, and if you had some sort of stroke or something like that, as well as a range of other medical conditions or medical illnesses, depending on what type of insurance you have, you could potentially be paid out under a trauma policy. Now, again, this is always going to depend on what type of insurance you have, who you have it with, what they deem to be a traumatic or crisis event, how comprehensive or basic your insurance cover is. So a basic insurance policy under a trauma cover might cover you for a range of events, maybe 5 to 15 events, whereas a more comprehensive cover might cover you from 15 to 50 types of medical conditions or medical events that may or may not occur. We can start to see what these insurance policies potentially cover you for, but it's important to always remember why. So the life insurance one we've mentioned, if someone relied on you, what would happen in the event of you passing away? How would your family support themselves? That's a bit of an easy one. Then we start working down the list. Okay, well, I'm currently earning $150,000 a year in my income. What would happen if I could never do this ever again? I'm currently 30 years old. I've got potentially 30, 35 years left in my working career. What would happen if I can no longer earn my current income, let alone what would happen if my salary increased? So what would happen? So my earning potential has now ended because I can never work again. What kind of replacement income would I need to get me through to age 60, 65 when I can access Centrelink or my superannuation or whatever the system is going to be in 35 years time? Again, not that we want to ever think about this, not that everyone likes to talk about this, but it's important to start to think what would happen if I had 6 months off work or I couldn't work for 6 months. You can start to see how our emergency fund and insurances start to work together. If we think about, again, that 3-month figure of having 3 months of living expenses, 3 months of income, or 3 months of savings, whatever you want to think about it as, we can start to see, well, in the event of me not being able to work for 6 months, that would be pretty bad. How would I survive? Okay, 1, I've got my emergency fund set aside, tick. Okay, well, that gets me through for 3 months. What would happen from 3 to 6 months? What would happen from 3 months to 12 months if it was something more severe? The way that we think about insurance is Again, no one wants to talk about it, no one wants to pay for it. But the reason we put in place insurance is that we can't afford to pay for something if something went wrong. So the reason we have car insurance, or I guess the main reason to put in place car insurance, is what would happen if you either crashed your car or crashed into someone else's car? Could you afford to pay to replace your car? Could you afford to pay the damages for someone else's car? If the answer is no, then unless you're a risk taker and like taking risks and just say, whatever, I'll deal with it if it happens, then that's a need for insurance. So if you can't afford to pay for something, then insurance is your next best option. So if you said, well, I had a car accident, or if I had 6 months off work, again, using that passive income example, if I was off work for 6 months, it wouldn't matter because I've got rental income coming in, I've got dividends, I've got passive income coming in from businesses. Then your need for insurance is next to nothing because you wouldn't be affected in the event of you not being able to work. However, for most people that we've talked to, their need for insurance is high because they couldn't afford the alternative. They couldn't afford not to work for 3 months, 6 months, 12 months. So step one, having the right amount of emergency fund in place. And then step two, having an appropriate amount of insurance in place. We don't want to overinsure and we definitely don't want to underinsure. Again, thinking about the main reasons to have insurance in place is one, could you afford to pay for something, or could you afford not to work for a period of time? If the answer is no, then thinking about, okay, what's my plan B? And insurance sometimes helps to fill that gap. The other thing to think about is life events and what happens in the event of your life changing that would then determine what do we need to do with your insurance cover. We find that for most people, they follow the normal path of getting married, having children, buying a house in some order. And we find that the highest need for insurance is when their debts are the highest and their children are the youngest, because that is when they're the most vulnerable. That in the event of them passing away, their family, whether that's husband, wife, whatever your situation is, would be financially impacted if someone, or both people, parents in this case, passed away, because they have a high mortgage and their children are the youngest. And so therefore their children are dependent for a long period of time. We usually find that as children get older, so we go from age like 5, 10, 15 years to 20 plus, children become more self-sufficient or less dependent on their parents because they're working or doing whatever, moving out of home. Therefore, usually what happens at that point is their mortgage is coming down at the same time. So the children are getting older and the mortgage is coming down in most circumstances. So therefore, the need for insurance would usually, not always, but usually start to decrease over time because as the dependency of the children is becoming less and the severity of something happening, mainly talking about life insurance in this instance, the financial burden of something happens becomes less and less because we have a lower mortgage and our dependents, children, elderly parents, whatever we want to think about that as, is becoming less and less as we get older in most circumstances. So that's why it's important to always think about, okay, as my life changes, if I'm going from being single, no dependents, no debt, to then taking on a mortgage, having children, maybe starting a business, buying a second property, having a second child, all those things we can start to see. We need to always review our insurances to make sure that it remains appropriate as our life changes. So as we start to pay off debt, children get older, things become simplified, maybe our assets grow, maybe our passive income increases as we get older and older. Therefore, our dependency on our one source of income, being our job, becomes less and less. We can see how that starts to affect things as we progress later on in life. Before we wrap up today, I want to take you through a couple of other things when it comes to insurances and what you need to look at before putting in place an insurance policy. So anytime you take out an insurance policy, whether that's your phone insurance, car insurance, health insurance, home insurance, life insurance, whatever it is, almost guaranteed there will be what is called a product disclosure statement. Now, product disclosure statement is going to be that big lengthy document or email that they send you as attachment that outlines absolutely everything to do with the insurance policy. We find that unfortunately for most people, they don't read it because it's usually 100+ page document and it's full of really small terms and conditions. But there's a couple of things that you need to either read through and understand yourself, or if you're talking to an advisor or the health insurance company directly or whatever it is, you need to ask and understand before you take out any type of insurance. Now, this isn't an extensive list. You should always do your own research. You should always find out as much information as you possibly can before proceeding with any financial product, especially insurance cover. But these are just a couple of things that you need to be aware of to help you make an informed decision when it comes to insurances. Number one is what's included and excluded in this policy. Now, using the disability example, what would be considered a disability and what's not considered a disability? If you have any pre-existing conditions, so thinking about the trauma or the crisis cover example, if you had a pre-existing condition of some sort of cancer related illness, it would be very unlikely that you would find an insurance company that would be willing to insure you for that type of cover. So that's what's called underwriting. So you go through an underwriting process for most insurance policies, depending on what you put in place. There's some that don't, but a good insurance policy would go through medical underwriting, ask a bunch of medical questions, and it's up to you legally to disclose any information that you would deem, or the insurance company would deem, relevant. So if I had a history of cancer and I was applying to put in place a trauma policy that would cover me if I was diagnosed with cancer, I would need to disclose, or legally need to disclose, that I had some history of that condition, and then it would be up to the insurance provider to say, yes, I'm willing to insure you, or no, we're not willing to insure you. So that's important to understand what's included, what things would I be covered for, and what am I not covered for. The next one, which most people ask straight away, is what's it going to cost? So that's what it's called, an insurance premium. So you might be familiar with that example when it comes to health insurance and car insurance and things, but that is your insurance premium, and how will that change over time? So what am I paying today, and will that change as I get older? Will that change if I need to increase or decrease the insurance policy? What will happen to this insurance premium, and how will it change over time? The next one is waiting periods before you can make a claim. So waiting period, something that we're probably really familiar with when it comes to health insurance, that if we switch health insurance providers, they usually apply a waiting period of when you can make a claim on a particular item of that policy. And it's really important to think about that when it comes to personal insurances. What is the waiting period? So if I took out a policy today, could I claim on it tomorrow? If I took out a policy next week, can I claim on it in 6 months? Each insurance provider and each insurance policy is going to have different waiting periods. So it's just important to understand, what am I covered for? When can I potentially take it out if something did happen in the next 6, 12, 18 months. The next one is, how do we make the claim? So if something did happen, and touch wood that it doesn't, but if something did happen, how do I make the claim? Do I go to the advisor or the consultant that put in place this insurance policy for me, or do I go to the insurance provider directly? Is there a phone number? Who do I contact? Is there a call center? What is the process when it comes to making a claim? And the reason why that's important is, if you're making a claim, something bad has happened. So it's important to know this ahead of time, that okay, I've got a policy document, I've got that number, that here's the person to call, here's my advisor, here's the consultant, here's the right person in the event of some sort of crisis or something happening. You don't have to spend a couple of hours, you don't have to spend a couple of days trying to figure out how to actually claim on this policy, because you want to make this as simple as possible in the event of something happening that's obviously some sort of crisis event. The next one is, how do I make a complaint? When we talk about insurances, there's usually a lot of war stories. You just do any search on the news saying X insurance company paying claims or didn't pay claims, you'll see it's all over the news. So it's important to know that, okay, well, what do I do in the event that I did submit a claim and I get knocked back, or I submit a claim and they tell me that I'm not covered, or a policy lapsed? So it's important to know what would happen if I do need to make a complaint. Who do I go through? What's the correct channels? Because again, something severe has happened, and we want to make sure that whatever you have in place, whatever policy you have in place, is one, going to pay you, and then two, if they don't pay you, what are the steps that I can go to potentially rectify that? So as I mentioned, there's a product disclosure statement that comes with all insurance policies. Recently, they've also put in place something called a TMD, so a target market determination document. So it's important to look at those documents, understand what insurance you put in place before you take out any form of financial product, and especially take out insurance products. So the final thing I want to leave you with today is, we need to figure out what insurance you do need, but importantly, need to figure out or find out what insurance do you already have in place. So this is something that surprises a lot of people when they come to see us, is they don't know that they already have insurance in place. The reason why a lot of people have insurance in place they aren't aware of is that for most people under their superannuation policies, their provider would have some sort of default insurance cover. Default insurance cover is something that is usually provided by most superannuation companies, and they give their members as a benefit. They charge you for it, but it's a benefit. They provide you with default insurance cover. Not everyone, but quite a lot of them do. So this might be default life insurance, disability cover, income protection. Trauma cover and crisis cover is, for 99% of the cases, not included in default cover, because without getting too technical, you can't, or you're not allowed to hold trauma or crisis cover inside a superannuation fund. So very, very rarely, it may be in the exception that you had a very old policy, but for 99% of people, you may have the option of life insurance, disability cover, and income protection already inside your superannuation fund. So it's important, before you put in place any other policies, or before you cancel any other policies, that you look at what you already do have. And the best way to do that is log into your super fund provider, or call the super fund provider and just ask the question. Say, hey, do I have any life insurance, income protection, disability cover? Am I paying for anything already? Before making that decision of, okay, I need to put in place more cover, always consider what you already have in place. So that covers off step number 2 of your financial protection plan, which is insurances. I've included a number of resources below in the description, so be sure to check them out if you're wanting more information regarding both emergency funds and insurances. But just a quick recap on today, we've spoken about the importance of having an emergency fund in place, how much you may need to have, where you're going to store that money, and what's required to obviously build up that savings over time. And then step number 2 is having the right insurance in place. So considering what life insurance policy you might need, amount, type, etc. Disability cover, so total and permanent disability or TPD insurance. How much do you need? Do you need it? What do you need to have in place? Income protection, just thinking about what would happen in the event of me not being able to work for a short period of time, be that 3 months or 6 months, or potentially a longer period of time of 1 or 2 years. And finally, do I need to consider putting in place trauma or crisis insurance? So thinking about what would happen if some sort of major medical illness or I was diagnosed with some sort of major medical condition, how would that impact me financially? And is that something that I'm worried about? If the answer is yes to both those questions, then it might be worth looking at putting in place an appropriate amount of trauma or crisis cover. Once again, put a link to all these resources below in the description. I hope you found this episode helpful. Be sure to check in next week where we talk about step 3 of your emergency fund, which is the very, very exciting topic of estate planning. Have a great week.
If you've enjoyed this episode of More Than Money, make sure that you subscribe to keep up to date with all of the latest episodes. And feel free to like, comment, and share with a friend.